Welcome to the Broken Pie Chart Podcast, episode 377. I'm your host, Derek Moore. With me is Shane Skinner. Mike Snyder is on assignment. He's not really on assignment, but it's that's what they usually say in the news business, not that we're part of the news business. But let's talk about rates, Shane. So we'll get to markets. Rates today, I think the 30-year bond yield crested 5.1, and that is the highest yield on the 30 in, I don't know how long. Interestingly enough, the 30-year is lower than the 5 and the 10-year. So 30-year is lower than, no, that's not true. That is not true. Why am I'm looking at a Bloomberg chart. The 20 and the 25-year is higher than the 30-year. 5-year is 4.28, 10-year is 4.61. So, I mean, this is it's more of a normalized curve where the rates on the short end are lower than the middle, and they're lower than, and the middle is lower than the longest end. And some people are saying, this is bearish. It's a bear steepening. Other people are saying, look, it's a bull steepening, because what you're seeing is rates are reflecting on the back end the future growth. And we know that there's been studies done on this. If you look at nominal GDP over a 10-year period, you look at the 10-year yield, historically those have some sort of linkage. So, I mean, today we ended about minus 1.25% in equities vis-a-vis the S&P 500. I will also tell you, looking at Bloomberg has a function, those of you on Bloomberg, WIRP, not the radio station, they are pricing in a full basis point or 25 basis point hike by May of 27. There is, let's see. Yeah, now the probability of that hike is still not 100. I mean, it's not. And this moves around. But think about it, Shane. We have a new Fed chair got sworn in this week. Powell's not going until everything gets wrapped up to his satisfaction. So he'll be there, but as he ducked down at the press conference, he'll be taking a very reduced role as a FOMC member, but not the chair. I don't know. Like, to me, aren't we still up for the week in equities? And we're up, 8.5% year to date in equities. So really, so could we see rates not be reduced and the market still go up? Or is this regime shift going to cause problems for equities?
It seems like there could be a potential argument for this and the CPI and the PPI thing. It seems like just a perfect sort of mix right now. And yeah, it's almost as if the markets, after this squeeze has sort of ran its course here, and we sort of maybe stabilize for a little bit, what comes next? I'm with you. I thought that we were going to cut, or at least the idea that he was going to come in and cut immediately or within probably 6 to 12 months. That's sort of what I was thinking was going to happen too. And so with that being said, though, we've seen rates go up and the market go up before. And breadth is interesting right now, because I think we're starting to see that retracement back to, a very concentrated area or names of the market seem to be leading the charge higher. But I mean,
but the market needed that
before, right?
Well, the market needed that. Remember, everything else was sort of catching up for a while. Like the equal weight index was outperforming the Mag 7 for a bit, and we always said, I mean, you sort of need those big leaders to come back. NVidia has run, everybody's run. Like I don't look at one day, but it is worth noting. I mean, 3.8% was the year-over-year CPI, US CPI, urban consumers year over year, 3.8. That's higher than it was. That's higher than 2.4, which is what it was in February. And that is higher than March, where it was 3.3. So if you look at that and you're a technician and you didn't know this was CPI, you just looked at it as a stock chart, you'd say, well, it's building a base, it's broken out. Maybe now it's going to come back around. Now, I would say that raising or lowering interest rates will not necessarily do anything for the price of oil. And if you look at oil, you can do this. You can look at the swap, the futures-based swaps, and look at the curve there. The May WTI, West Texas Intermediate, is 102.63. Brent is 108.97. So that's higher. Now, those have come down a little bit. You look at December. So by the end of the year, the swap rates are saying WTI is going to be 81. That's what the futures market is basically saying right now. You go out to Feb of 27, it's 78.85. That whole curve has risen. I think at one point, those months, the latter months I just mentioned, were more like 55, 60, 65. Those are higher now.
Right.
So, if this, I don't want to get into the whole, I'm getting bored of the whole, well, if this thing ends, if the conflict ends and this and that. Yeah, if oil comes down, that would be helpful for inflation. But I don't think that interest rates raising rates doesn't reduce oil prices.
Well, exactly. And I'm with you on that in the sense that, again, we've brought it up before, right? Supply side inflation versus demand side inflation. Fed can't control supply side inflation, and there might even be the argument for, look, if there's a supply shock, there's a lack of a commodity or a material that's heavily in demand. Lower rates encourages more CapEx borrowing, stuff like that, makes it easier to get the operations and businesses the money and the ability to do that in a manner that's, a little bit more affordable. It allows for more risk to be taken, if you will, right? But that, then there's the concern, that's going to allow demand to stay hot. Well, seems to have stayed hot for the most part, across the board. So, I don't know. If it's a supply side thing, you can't stop it.
So, my thought of, there's core inflation, X energy and food, and then there's super core, which is X shelter, housing, energy, and food. And then there's another one that's just like, if you can keep taking out things until you get the result that you want or don't want. But I did look at just CPI. And so Bloomberg has an attribution where the year over year for April was, 3.811% year over year increase in prices. So then you look and you say, well, core was 2.75. But within core, you have shelter. So then I look at, energy, if you take 3.8 minus 1.14, let's just round it to 1.2, right? Well, that brings you to 2.6. And then shelter itself was 1.17. So now that's, what is that? 1.10, 1.07, 1.05, if you take those two out. Like shelter has been pretty consistent. And although it's come down, this is higher. This is the highest it's been since, September of last year, but not materially higher. So, I guess the question is, if truly we see another inflation regime, like if that's going to happen, of course that's not going to be helpful because bond yields are going to spike. Bond prices will go down. The discounted, when you look at discounted cash flows and you analyze companies and the discount rate is higher, that's not helpful. But, look, you look at earnings, and earnings are still, analysts have good earnings estimates. They're reporting good results. So, look, I don't know. You and I thought Warsh would come in and he's brought into lower rates. So maybe he doesn't do it at the first meeting. But is he really raising rates?
I don't, that's the thing. I don't know. Like, he may have given off, I guess, the impression that he was open to it and then gets in the role and then does a double take. I don't know if that's going to happen or not. I again, I'm with you in the sense that I don't think raising rates is going to solve an energy shock. And at the end of the day, there have been, I think there have been times where like if you see repricing, what you just described, right, in the debt market, a lot of people, the debt market's boring. They don't like to look at it. It's a very important part of the market, and it affects the equity market pretty heavily when major adjustments happen in that area. And so I think what you just described about, well, if this throws off the expectations, or they do actually end up going through with raising rates, if they did, right, that sort of causes a mass sort of restructuring of what expectations leading into this seem to have thought would go the other way. And yeah, like money might be positioned one way for this, and if it goes the other, maybe that causes a little bit of a pullback or a reshuffling of things.
I'll give you the other side of this. U.S. Atlanta Fed GDP Now, which of course looks at data points as they come in. It's a nowcast. So currently for this, so what are we? January, February, March, April, May, June. So this is for Q2, kind of the running Atlanta Fed GDP Nowcast. It's showing 3.99%, so rounded 4%. Like if you have real GDP growth in Q2 of 4%, that's pretty good. Like that's really good. So you have this dichotomy of growth and GDP, at least forecasted. You've got growth in equity earnings. You've got expected earnings growth. And then you have the Fed or the Fed funds futures pricing out that there could potentially, it's pricing in a 25 basis point cut by, what did I say, March of 27. So look, I don't know. And, with us exporting oil, exports, it's, the GDP, for anyone who forgets the economics textbooks, imports minus exports. And for many years, we were always importing net amounts of oil. We're a net exporter of energy now. So, that definitely helps. So I don't know. We'll see. But despite all of this stuff, equity markets are up 8.5% this year. And I think you mentioned, Shane, we were positive for the week, right?
Yep. We finished positive on the week. And, in terms of like the structural flows, until those shift, like you're going to continue to see the institutions, the passive, right, retirement flows, right, just keep coming in. And like this market's been very resilient.
Would it surprise you though if we just had a 5% pullback for no other reason than we've gone up so much? Look at SOX, the semiconductor index.
Yeah, no, it's gone
off the lows. You're talking about. I'll just tell you what it is off the lows. Let me just click on two buttons and I'll tell you. So the low was March 27th this year. The high was May 11th. It's up 69.15% off the low. And then you say, well, what is it off the high? Because it's only nominally off the high, but whatever. Let me do that for you. And I'll tell you that amount. We're 4% off the high. So if the whole market was semiconductor, you say, oh, we're at a 4% drawback from the all-time high. Like that's nothing. So sometimes stuff just needs to pause for a while. Like you could make a case that it's run so far so fast. Would it surprise anybody if we had a 5% pullback in the markets? And I would say no. And in some regards, it might be healthy. So these things really run.
Yeah. If you're a technician, you're kind of looking at this going, what in the world? Everything's, red hot, in a lot of different areas and studies, if you will. But it's at the same time, like you said, 4% off, 60 some, that's nothing. It's really nothing in the grand scheme of things. And if you were patient and you sat through this whole thing over the past 5 months, you probably pretty happy, right? And, just to give you some quick numbers, all right, Max 7 individual names year to date. Microsoft down 10.79% year to date. Meta down 5.56%. Tesla down 3.61%. Apple up 10.78%. NVidia 19.31%. Google 25.9%. And Amazon 16.62%. So you've got 4 out of the 7 up 10% or more, with Google leading at 25 and NVIDIA second around 20. And then you've got Tesla, and Meta and Microsoft down. Microsoft down 10% year to date. So I bring this up because this just goes back to like, good luck knowing which one's going to do it, which one's not. Like,
well, that's why you buy the index, because you own everything. Because
the index is at its highs, and look at Microsoft. If you were full tilt into one or two of these names, you could be missing this entire thing.
454 out of 499 companies have reported in the S&P 500 index the current season. Sales growth year over year. So this would be what, Q1 of this year to Q1 of last year. 10.5% sales growth, earnings growth of 25.09%. And then you look at what's been the surprise. So sales surprise is just under 2%. Sales numbers above expected. Earnings have been 17.61% above expected. Like, this is pretty good. This is really good. Like, yeah, I mean, 25% earnings growth. Are you okay with that? Yeah, I think we're okay with that. So, all right, I want to go to, I'm excited to see if it actually comes back next week. And of course, we also have NVIDIA earnings that we'll talk about. We got to look at the option volatility there. So I did a search, and according to a search, the public SpaceX S1 registration statement is expected to be released between May 15th and May 22nd, following a confidential filing on April 1st, 2026. So the filing is expected to last at least 15 days before the roadshow begins, which is planned for the week of June 8th. So for anyone who's not familiar with what an S1 is, an S1 document, when a company goes public, the S1 eventually gets released, and it's almost like it's the first opportunity you get to look at a little on like perspective-y stuff, but it's you get to see some financials. So you'll see, a lot of times companies put the trailing 12 months. You'll see their sales numbers, their earnings, and statements and risk and different things. I can't wait to see if this comes out next week. So, because I mean, Shane, like for the first time, we're going to see like, what is your actual revenue? What are your earnings? I mean, this thing's supposed to be a $1 trillion plus IPO, although I think they're only raising, I read somewhere, under 100 billion, which is a lot still, but under 100 billion is actually going to be available in the IPO to the public. But the total number of shares, based upon the offering price, it's expected to be over 1 trillion. I think, in fact, there's some people who say it could be 2 trillion. So, one, did you get an invite to the roadshow? And two, like, you got to be excited about seeing this S1 drop.
Yeah, it's. I think I saw something like Elon Musk gets paid like 50-something thousand a year from SpaceX. I think that's like his salary. I thought that was funny. I saw that this week. It's going to be interesting. I think that. Did you see the news this week or last week, I should say, NVIDIA is really ramping up interest at this idea and concept of putting data centers into space.
I did see some of this. Yeah, I've heard some talk about it.
So, there's some potential here for this to be really, really big, I think, in terms of the use case, right? What you do in space, right? Satellites, you can, if they're going to put data centers out there, that's a huge help in terms of not taking up as much space or resources here on the planet.
I gotta think cooling would be better.
That's what I was thinking, right? And then I was talking with my brothers, and they're like, probably gonna have it powered out there on its own too. Like they're not gonna have to really do anything. It would seem to be pretty self-sufficient, I would think. The question is, does SpaceX, do they colonize the moon? Do they really colonize it, create a city there? I mean, it seems like that's something that's, I think, embedded in Elon's contract in terms of like his shares or his payout or whatever he gets. He's got
he's got the benefit of, he could transport the materials because he owns a rocket ship, literally.
Right.
So let's think about this. And I don't know how, the mechanics of ownership of the moon or who can do what there, or who can just put a space station that floats around in orbit. But imagine you don't have any permits. You don't have like zoning issues. You don't have property taxes.
Yeah, no regulation, no ownership out there. Nobody's.
I mean, in theory, but at some point.
Well, that'll come up, right?
Yeah, I mean, that's going to come up. But yeah, you have the natural cooling, and then you have this thing called solar energy, legit like direct sunlight for if you're on the right side of the moon. So yeah, I mean, it is interesting. Now, when does NVidia report earnings, Shane?
That's going to be Wednesday after the bell next week. So that's May 20th. And it's a big one. And I think
we always say that. And then a lot of times it actually isn't. Let's be honest.
To quote Mike, this is always the most important earnings, right? Like every time, it's always the most important earnings report ever. Always, every time. And it's, I'm with you. The markets ran up so much. The pullback or a cool off here for a little bit, maybe some range bound trading sideways. I wouldn't be surprised to see it across some names or even the index. At the same time, though, if they come out and it's a really, really big surprise beat, right? I think the market probably is satisfied with that, and things continue unless, anything comes up to make it think that that's going to slow down. It seems like, NVIDIA, like you said, SOX has sort of led the charge here, right, on this run up, and NVIDIA is probably the biggest part of that.
Let's take a look at the options market. So implied volatility, looking at the center strike, the 225, it's about 67%. I always take the square root of 252, which is 15.875, and a whole bunch of numbers after that, 16% divided by that. So the 1 day, one standard deviation based upon that is about 4.22%. And if I'm looking at the options for next week, so that's actually 5 trading days, you take the square root of 5. So a little live math here for anyone who enjoys this stuff, or maybe you don't enjoy it, but that's okay, which is 2.236. What did I say? 4%? 4.2 was like the 1 day?
Yep.
So, between now and then, a one standard deviation move would be, 9.4% is basically what's priced in. So if you bought the straddle, which means you're simultaneously buying the call, buying the put, you think it's going to move a lot. I don't care what direction. Remember, volatility is very high. So this is a trade where you can be right on direction, but not right enough. So if I look at this, call it $17-ish. Is that what you see? Right, $17 for the straddle. What that means is if you bought this right now, you'd have to break even. The stock would have to go up $17 to $242, or it would have to go down $17 to $208. So $208 to $242 are the areas if you bought it. It's got to get outside of those range. If you sold it, if it stays inside the range, you'd make money. It goes outside of the range, you lose money. And of course, if you're short a straddle there, unlimited loss potential to the upside and loss all the way to zero. This feels about like this implied volatility feels about right based upon historically what we normally see in NVIDIA. So Yeah, like this feels right, Shane.
Yeah, no, I agree. And, you know, just looking at it a little deeper relative to where it's traded recently on the chart, that's basically pricing in new all-time high to the upside, right? Slightly above all-time highs. Okay. And then if not, you're coming, I'd say, down to about around or just below the 20-day simple moving average. So I think
Uncanny how this works.
isn't it beautiful how it all just lines up together? Yeah. And so, yeah, I mean, and you traded around 210 for quite a while, right? You sort of traded up and through it, came back down, hit the 20-day, rode it for a few days, back up and through. So to go back down there and test that as support where the 20-day is now, and you haven't been there in, I'd say it's been a week and a half, almost 2 weeks. That wouldn't be like that big of an issue or a surprise.
I mean, it was down 4.5% today, wasn't it? Right around 4.42%.
Yeah, 4.4. Yeah, down like 10.4.
So, I mean, it moved that much one day without earnings. So would it be a surprise if it moved over 10% one way or the other?
No,
it wouldn't. It wouldn't. So it just kind of, it's pricing that in.
Yeah. Yeah. I think it's fair. It seems to make sense, right?
The thing with NVidia that's, when I look at that, I feel like their historical returns have been really, really good. And, you sort of look at that and you say, well, what's going to change? What would really change? And I guess it's obviously their forward statements. Like, could you see if Jensen comes out and is like, yeah, we're going to make so much money in space. We're going to do all the data centers. Or it's all going to be our stuff. I think the stock would like that. And maybe that's what they have on top. I don't know. Or if, like, what's the negative here? The negative is obviously the size of the orders. They give guidance that's not as good. But to really, I mean, there's all sorts of negatives that can happen. I'm sure they'll talk about, I'm sure every CEO is mentioning oil prices and inflation and the risk of companies pulling back, but I don't know.
So
it may just not move.
Right.
It's done this before, where it comes out and they kill earnings and it just doesn't move.
The last 3 earnings, they traded in like a 20-point range throughout the 3 quarters. It's, it's not uncommon for NVIDIA to sort of just sit sideways earnings week. But I agree. I think the market wants, obviously, to hear that there's continued expected growth, and it's strong, right? I don't.
What if I told you in the last 8 announcements, they beat all 8? Their EPS is expected to 1.7637, according to Bloomberg, is their EPS, their adjusted EPS estimate. But according to Bloomberg, 8 out of the last 8, they've beat. 0 met, 0 missed.
I wouldn't be surprised. I'd believe that. And it wouldn't surprise me if they beat again. And, he was a part of the coalition that visited China this week, I believe, or this past weekend. And that's the one that I'm waiting for is there an announcement on some type of agreement or deal with being able to sell chips to China? And if there's talk of that, that ups a lot of revenue, right, that you were cut off from prior. And so there's another area where maybe the market's not committed to believing if that's going to happen or not yet. I don't know if it's priced in, right? I'll tell you in a few weeks. But I think the market might want to hear some stuff about that too, given his recent, involvement with that. And,
So I'll give you a little stat here. So their forward PE is, what is it, 24.25. Their trailing PE, the price to earnings, is 48.79. Like, I wonder if it means anything. This is like on the fly. I'm just thinking this. You divide the trailing PE divided by the forward PE. It's a lot, like 40. All right, let's just do it. 48.79. There's some ratio here that's interesting. And in other words, the reason why their forward PE is basically half their trailing is that earnings expectations have gone up so much. And it almost seems like, I mean, if I'm doing this right, the earnings, the expected 12-month are double what the trailing 12 months was. Think about that.
I mean, again,
that's how much the earnings.
But that's sort of, that's in line with the kind of moves we're seeing, right? Like it's not like analysts are being timid about their expectations on this stock and their numbers and what they come out with each quarter. They seem to keep delivering in a manner that they like, and that's the thing. It's picks and shovels. They have a very wide moat, a very wide, very deep moat in terms of their embeddedness into the AI build out, right? And some people make the Cisco argument, right? Cisco in the 2000s, which look at that thing, that took off, I think, this week.
Everything old is new again. Cisco, Micron,
yes, yeah.
Intel.
Yep.
It's all the companies we traded in late 90s.
Yeah. I mean, but
that's the reality right now.
Yeah.
If I look back, so this quarter is 1.7637, and I think when I looked same quarter a year ago, it was like 93 cents. So a little under 2 times, a double from last year. Yeah, I mean, when you look at this stuff and you just say, okay, like what do they have to tell the market? You have a company that's doubled their revenues or doubled their earnings from one year to the next based upon but they haven't doubled them yet, but I'm saying the analyst forecast. So, all right, we'll see what happens with this. Maybe it's a nothing burger. We've seen those sometimes because NVIDIA is late. And that's the other thing people have to remember. We've already seen Taiwan Semiconductor's earnings. They make a lot of this stuff. We've seen Intel's. We've seen AMD. And we've heard companies talking about the CapEx spend. Analysts much smarter than me have already gone through this stuff, and they've done their estimates. They've done their forecast. So a lot of this stuff is really priced in. It's... But yeah, I mean, you look at calendar year 2020, year ending 2026, 477, 842, I think is the estimated. So, it's not quite double based upon the estimations, but when I look at PE, forward PE to trailing PE, it's kind of half the trailing PE. I'm just saying.
Well,
that's
and
what it is.
If you look in the 52-week back period here, like. Mm-hmm. 129.16 was the low last May. 129.16. The stock closed today at 225. It reached a high this week of 236 and a half, roughly.
Yeah, so over 100-point gain.
So it's,
yep.
Yeah. I mean, $107 off 129. So that's almost doubled, right? It seems like the price of the stock has moved. Not one for one, but pretty close in line with that. That's interesting.
So if we look at NVIDIA, so here's an interesting way of looking at it too, because we know Intel's been running, some of the other companies have been running, and we look at something like the SOX index. So if I look at this and I say, okay, what's happened over the last year? And so I'll go back to May 15th of 2025. I'll look at May 15th of today. NVIDIA is up 67.11%, that's a huge move. I think we'd all agree, total return. Total return 67.15. The SOX index is up 136.76% total return. So you could have owned NVIDIA and made 67%, but the SOX was better. Like getting that diversification because there's other companies that are in there that have like Intel has got to be, a big driver of that too. So, and the S&P over that time up 26.71, a 1 year look back. Like a year ago, if you would have said, do you want the SOX index or do you want NVIDIA? Like, which one do you want? I think people might have had to think about it. In hindsight, it's like, oh, you would have been better off with the index. So there you go. All right. What else we got today? So I want to just touch on sentiment a little bit. And I still think it's not as hated of a rally as it once was, because I'm starting to see some FOMO and just in talking to folks. But there's still a lot of people who are saying this can't go on, this can't last. There's other people, and they might be right, that say we've gone up too far too fast, we're due for a pullback. Look at Micron, look at all these stocks, look at Intel. Like, it just is what it is. They've gone up so much. I still think from a sentiment standpoint, there's a lot of bearishness. And I always go back to March of 2000 because that's thought of as the bubble. And people have said they don't think this is necessarily a bubble, but it's not cheap. Where March of 2000, there were clearly things that didn't have any earnings that they were trading at multiples that were crazy. But in March of 2000, it was like people were buy anything, it can't go down. Buy, 5 houses, it can't go down. Well, maybe that was 2008. That's a different bubble. But I don't feel like the euphoric nature of March of 2000 or like 2008 or 2007 with housing, I don't feel like that's present right now. Do you?
No.
Just from what you're hearing, people, like, are you getting some people saying, all right, I never invested before. I need to throw in and get some of these semiconductors. Like, I'm not hearing that.
Someone near me, right, in my neighborhood was talking about, how he was looking at his 401k every day over the past, 2-3 months. And he just finally stopped because he realized like it's not doing him any good. Right. It just, if you're
cheering for it or just being concerned about it,
And, it was funny because he sort of came around to the conclusion like, well, I'm invested for the long run. Right. This is someone who is a little bit not in their 50s or 60s. Right. I believe they're in the 30s. And so it's like, I still got 20, 30 years, right, before I'm going to retire. It's like, it doesn't really matter. Like you've told me on the day to day, to someone that's in growth mode and high risk tolerance, to other people, it's this is why you buy and hedge, and because you don't know when something's going to come, and you can't afford to miss out on the potential for this stuff to keep going up. Right. You don't want to be on the sidelines if it's going to keep going up. And at the same time, it's okay to be concerned or have thoughts about, potential downturns. And, the answer to that is if you effectively hedge, you can manage that risk and still, again, stay long the market and participate in it, whether it makes sense why it's going up or not. If you've been on the sidelines the past 30 days, you're begging for a pullback now, right? Because where do you even get in now? The SOX, like you said, ran 60% in that time, basically.
Yeah. So there's an interesting thing, and I would say you can buy at all-time highs. There's these different things. Like there's been studies done on if you buy at all-time highs, generally the markets are pretty good. Hartford Funds put something out last year. Buying following an all-time high versus all other times. And over the next 12-month period, historically, let me see, 12-month returns higher. Yep, averaged 10.4% from 1926 to December of 2024. So this isn't really updated, but 10.4% buying at all-time highs. A year later, 8.8. buying at other times. 24 months, it's about even, and 36 months, it's about even. And so this is some data from Hartford funds. But here's the thing: like, there's this quote from Buffett. Be fearful when everyone else is greedy. Be greedy when everyone else is fearful. I think the better way of looking at this is, like, when everyone is panicking, those may be good buying opportunities. But I got to be honest with you, and these don't come around very often. Some of the best buying opportunities where apathy comes in. And I can tell you in 2002, the third year of a market downturn, 2000, 2001, 2002, people became apathetic. Like, they didn't even look at their statements. They didn't even do anything. And it was the same thing in 2009, where people were very fearful. People were worried about it. People were trying to pick the bottom, whatever. And then they just stopped. Like, nobody was doing anything. They weren't looking at their 401k statements. They weren't looking at the brokerage statements. And that's really like these generational buying opportunities. And obviously that's not the environment we're in. But apathy is a great tell of when it may be a good buying opportunity. All right. Speaking of buying, any recommendations this week, Shane?
No, I've watched a lot of children's shows and a couple movies. It's been a big Winnie the Pooh week in this household. So
I think the listeners will be happy to hear this. Okay, Winnie the Pooh, good recommendation. Yep. I will tell you a quick story. I was once in an event at Disney, and they had. So I don't know if I'll get somebody in trouble by telling this story. Well, anyway, one of the characters, I got them to leave a message for my son.
Wow.
Which is pretty cool, because he was watching some of the Disney shows. This is a long time ago. And I was at this event, and part of the thing was they had some of the people who did voices for Disney. And it was pretty cool.
Wow.
As far as recommendations, I continue to watch playoff hockey. It's been great. Well, actually, I should say some of the series have been great. Some of them, like Carolina, 4-0. That series really, unfortunately, wasn't very good. But playoff hockey is great, and so I'm excited about that. I continue to watch. What did I watch? Friends and Neighbors. So I watched. There's a new episode that comes out, season 2. It's a good show, and then The Bear, which is a show on Hulu. I wasn't sure if it was coming back. They announced this week it's coming back in June for the final, fifth and final season. But they dropped a surprise episode. It's like a prequel of some of the characters before the time period where the show had started. And that's out. Like, they just came out with it. So you can watch that on Hulu. So
is that the Bear Gary? It's Gary, right? They're in Gary.
It's called Gary. Yeah. It's about
Gary and
about a road trip. It is, but it's about a road trip two of the characters make, and so. But yeah, apparently this is it, season 5 for The Bear, and they're done. So, but that episode is out, and then I think they're coming out with episodes. Might be June 20th, June 24th, something like that. But continue to watch playoff hockey. All right, that's it. By this time next week, we'll know what NVIDIA's earnings are. We'll know whether it was. You should have bought or sold the straddle. We're recommending neither, but we'll know when we know on that. And we'll see if it actually moves the market, what they do. All right, that's it, Shane. We did it. For everyone else, we'll come back next week and see what we got right, see what we got wrong. See you, everyone.